Now, I want to comment on that in the context of what's going on today, because I want to spend a few minutes before we start the lecture talking about current events, because finance, of course, involves current events. And right now, we are going through an extraordinarily interesting set of times. I think that's a Chinese curse, right? May you live in interesting times. Well, we're going through some really extraordinary times, because what happened over the weekend is something that has probably not happened since the Great Depression. What happened over the weekend is that the federal government took over two of the largest government-sponsored financial entities in the world, Fannie Mae and Freddie Mac. These are two government-sponsored entities. They're private organizations, but they have the backing of the government in some ambiguous sense. And it was ambiguous up until this weekend, what that meant. What happened was that these large financial institutions were responsible for purchasing the mortgages from various different regional banks and lending institutions. Why would they do that? What was their function? Anybody know? Yeah.
To provide a secondary market for mortgages so that the banks that are the initial lenders can generate more mortgages and make credit more available.
Exactly. Their goal was to really make credit more available in the housing market and the student loan market and the auto loan market, these consumer finance markets. The purpose of these two organizations was to buy up the various different obligations from banks and other financial institutions so that the banks and financial institutions could then go out and lend more money to more individuals that wanted these kinds of loans. So the purpose of these two organizations was really to support and grow these various markets. And it turns out that over the last 20 years, these markets have grown to epic proportions, tremendous proportions. And now, as the housing market has turned down, the original lenders that made these obligations are facing some severe pressures, and that's carried the ripple effects all the way through the financial system to the point where these two organizations literally could not stand on their own. And if there had been a default of these two organizations, there would be some major repercussions. We're going to talk about that in about 4 lectures. The material that we're going to develop over the next 3 lectures are going to allow us to analyze this situation and really try to understand what's going on in these markets. But I just wanted to alert you to the fact that something really big has happened. You won't understand fully what it is. You might read the newspapers, and I would encourage you to do so, but you won't fully appreciate the importance of it for another 3 or 4 lectures. But you're going to see this event unfold before your very eyes this semester, and that will provide the motivation for developing the tools to understand what's going on. In terms of the possibilities for the Secretary of the Treasury, Paulson, and the government, there aren't too many left in the sense that these two organizations are in a real bind in that they have issued lots of securities based upon their activities. And in order to maintain the quality of those securities, in order to make good on those promises that it has made to other counterparties, very important counterparties, I might add, including the governments of India, China, and a number of sovereign wealth funds that we depend on to loan us the money that has kept us in the style to which we have become accustomed in this country. In order for us to maintain those kinds of relationships, we have to make good on our promises. And it's getting harder and harder for these two organizations to do so because while they've got all of these promises that they've made, the money that's supposed to be coming in order to allow them to make good on these promises is dwindling. And as they've tried to raise more money in the open market, it's become harder and harder because people realize that they're in trouble and it's very difficult for them to raise that money. Yes, so the government said, okay, you guys, Fannie Mae and Freddie Mac, you can't make good on your obligations because you've got some problems. So we, the Treasury, will stand by all of your claims.
Can the government pay that?
Absolutely. You know how? How can the government pay that? What?
No, issue money?
Exactly. The government, they own the printing presses. So they just, you want to get paid dollars? I'll pay you dollars. Here, how many dollars would you like? I'm going to run it. Here you go.
So we'll probably see an increase in inflation.
That's the concern. So the concern is that if you do this too much, and you do it without anything backing up the pieces of paper you now print and give to your debtors, then there'll be a problem, because pretty soon they're going to realize that the piece of paper isn't really worth as much as they thought it was. So inflation could be a problem. It could be a problem. We'll have to see. But right now, the paper, the dollars that are being printed are backed by the full faith and credit of the US government, and for the time being, that still means something. So the question is all of the debt being guaranteed, or is it just how much Freddie and Fannie issued? Well, certainly it's what they've issued. So all of the paper that they've issued will be backed by the government. In addition, there's some new paper that they have to issue in order to finance additional mortgages, and the government will back that too. Now, this is not for free. It's not just printing presses. That sounds a little too easy. Somebody has to pay for it. The money's got to come from somewhere. Or put it another way, that money that is spent now backing these instruments cannot be used for other things. So if you believe in balancing your budget as opposed to spending on credit, which frankly is what got us into the problems to begin with, then there will be additional reckoning. People have said that the American taxpayer will pay for this. Well, that's true, but the question is, which set of taxpayers? Is it us? Is it your children? Is it your children's children? There are a lot of intergenerational questions about where the burden lies. But the fact of the matter is, yes, we are on the hook, that the American taxpayer is on the hook for tens of billions of dollars. Now, in the grand scheme of things, tens of billions of dollars is nothing. I mean, the federal budget is much, much larger than that. So this is not a big deal. The concern is that if this spreads and ends up costing us more because of ripple effects and knock-on effects that we don't yet know about, that could be a problem. And that, frankly, is one of the reasons why the Fed and the Treasury decided to step in now to try to contain this problem. How good they will be at doing that, we don't know. Read the newspapers over the next few weeks and let's see. There have been discussions about them going private, but private in a much smaller way. So the discussions that have occurred at the Treasury, and we don't know which way things are going to end up because it's a political process as well as an economic one, but there's a feeling that these two institutions got too big too quickly and that there wasn't enough oversight to allow them to be able to fail. In other words, they grew so big so quickly that after a point, they were in fact too big to fail. And when you're too big to fail, all sorts of abuses and improper risk management practices can go on. So Fannie Mae and Freddie Mac are called GSEs, government-sponsored entities, which means that they're not a federal agency, but they are backed by the federal government in some manner that has been up until now relatively vague. So they're meant to be private companies. They had a CEO, both of them had CEOs who were fired over the weekend. They have separate boards of directors, and they pay pretty attractive salaries, private sector salaries. But they were related to the government in the sense that their objectives were to try to support and expand the housing market financing, which was a government-dictated mandate to this. Their main goal was to create additional financing to allow the mortgage market to grow and to allow people to buy homes at reasonable rates. Their secondary goal was to make a profit on top of that. So that's why they're not just a government entity, but they have a kind of a quasi-private sector type of mandate. And by the way, they did a great job. They did a great job in the sense that the housing market has grown tremendously. Now, you could argue that that was irresponsible and that created all these problems that we're facing today, but you talk to somebody who has a subprime mortgage that otherwise couldn't have afforded a house, that now has made every single payment and really enjoys living in their home and has a lifestyle that they couldn't have otherwise had. You talk to them and you tell them that it was a mistake. So it's not at all clear that this is a total disaster. It's unfortunate and it's a catastrophe from the point of view of the current holders of various pieces of paper that are related to these subprime mortgages. But there's a whole group of people out there that have benefited from these subprime mortgages. And so you've got to balance the costs and the benefits. And we're not doing that right now. Right now, we're just panicking because we're all scared like hell that something really is going to break. But there's a positive side as well as a negative side to every story. And so we're going to have to talk about that in a little bit more detail. But we can't do that unless we have the framework to think about it. So there are two groups of individuals that are involved. One are the shareholders of the companies themselves. And these are investors. A number of them are pension funds, institutional investors. So therefore, you and I, in our 401k plans, we might actually have an investment in one of these organizations through the plan sponsor that invests in various different entities. So like they're a stock that was traded on the exchanges just like any other stock. That's one group. And those are going to lose most of their capital. They're going to lose their investment. Just like when a stock goes belly up, the investors of Enron, too bad, they lose everything, they're gone. They knew it, they took the risks, and the risks don't always work out, so that's that. The other parties that are involved are the folks that do business with these agencies, the counterparties that bought the paper that they issued, these IOUs and other complex instruments that Freddie Mae and Freddie Mac issued. Those individuals we're hoping will be relatively happy about the outcome of the government backing the paper, because now the paper that they once held and thought was in trouble will have the full faith and credit of the US government behind them. And that is a major concern, because these counterparties are very, very substantial investors. If they decide that this paper is no good and they start getting rid of it wholesale, that will create some really significant market dislocation and mass panic. And that's what the Treasury stepped in to stave off this weekend. And hopefully, they will have succeeded. In fact, if you look at the data, it looks like they did succeed. But I'm not going to talk about that for another 3 or 4 lectures, because I want to show you exactly how to think about these instruments. And then we're going to look at the data and see whether or not they've actually done something significant. And you'll be able to tell by looking at market prices, by looking at the outcome of auctions like we did last time. We're going to be able to tell exactly what happened.